Hi guys, welcome to Money by Sunny. Today, we'll be talking about value investing. Very simply, value investing is simply putting money into assets that you think are currently undervalued and where you think there is significant potential for growth. This can take many forms. For example, investing in an undervalued stock. This could be a stock that has some technological edge over its competition. Investing in a company at its early stages, before it even goes public on the stock exchange. This could be one of the many startups that are currently building their businesses. Investing in a cryptocurrency that you feel has a lot of users, beyond the regular hype that so many coins have. Or investing in a property in an up-and-coming or growing area of a city, while prices are still low. In this video, we'll mostly be concentrating on the example of the stock market, since that is the most accessible investment for most people. After all, not everyone will have the funds available to purchase real estate. And investing in a startup while it is still privately held is usually only available to venture capitalists or high net worth investors. These also usually have a high minimum investment amount. One amazing example of value investing are the early investors in Amazon. Back in the mid-90s when Jeff Bezos was first starting up his now gigantic internet company, there was a group of around 20 investors who each put in about $50,000 in return for slightly less than 1% ownership. These investors clearly saw an opportunity in Amazon and were willing to part with $50,000 of their cash to participate in what they thought would someday be a very valuable company. Bear in mind also that this was back in the days when the internet boom hadn't happened yet. Fast forward to today, let's say mid-September 2021, the market capitalization of Amazon is around $1.7 trillion, meaning that a 1% stake would be worth $17 billion. This works out to more than 30,000 times the initial investment of $50,000. Of course, along the way their stakes may have been diluted by other investors who later got on board. But that is still a seriously incredible return over that 25-year period. This may be an extreme example. After all, the dawn of the World Wide Web and e-commerce is not something that happens every day or even every decade. However, there are still some common principles to take note of. Investing in something that is undervalued sounds simple enough, but as with many things in the world of money, and in life in general, the difficult part is how to execute it. How do you even identify the undervalued asset? And then after that, how do you invest in it and make it work for you? After all, many people end up losing money in the stock market due to a combination of picking the wrong stocks, selling at the wrong time, and other pitfalls. In my view, there are three basic tenets that you should always keep in mind. Do note, however, that this is not financial advice, as this is merely for educational and entertainment purposes. That said, let's get right into it. Number 1. Look at fundamentals. Warren Buffett is probably the most famous value investor in the world. He personally has a fortune of about $100 billion, and his investment holding company Berkshire Hathaway has a market capitalization of about $650 billion. There have been dozens of books written about Warren Buffett's approach to value investing. But one of the key cornerstones is the fundamentals of the company. What do we mean by fundamentals? We can roughly break this down into objective and subjective details about the company. The objective details usually refer to the kind of textbook financial analysis of the company, which are things like a company's key financial metrics and ratios, such as profit margin, the company's profit divided by its revenue, which shows how profitable the company is. Gearing or debt ratio, the company's debt or liabilities divided by the amount shareholders have invested in the company, or its shareholders' equity. These are just a sample though, there are many other financial metrics as well. For all of these, it's best to look back over a certain period of time, say 5 years, so that you can see if the company has a good track record. rather than being a one-hit wonder that has only shown good numbers in the past year. Some of the other key components in the company's fundamentals are more subjective. They'll include features such as A. The company's competitive advantage over others. Warren Buffett refers to this as the company's economic moat, which is the barrier against other competitors from catching up. The wider this figurative moat is, the better. B. The strength and ability of the company's management. This can be a big determinant in how companies perform. After all, even if a company has a great competitive advantage or access to some large stores of natural resources, it's up to management to devise and execute the right strategies in order to maximize the value of those advantages and deliver growing profits. A combination of these objective and subjective details will give you a good indication of how well the company is set up to grow. It's now a question of determining if the company is undervalued in the market, which is probably the most difficult part. Two of the most common ways are by looking at the company's stock price relative to its financials, specifically price to earnings ratio or PE ratio, which refers to the company's share price divided by its earnings or profits per share, and price to book ratio, which refers to the company's share price divided by its book value per share. These are usually both readily available online, so you probably won't need to calculate them manually. You will then compare these ratios against the company's other competitors in the same industry to see if there could be any undervaluing happening. For both of these metrics, the lower they are compared to their competitors, the more potential there is for undervaluation. For example, you would compare PE ratios of Mercedes-Benz and BMW, since they are both luxury auto companies. But you wouldn't compare BMW with Apple, since they are in completely different industries. Although with the rumors of Apple coming up with their own electric car, this may not be the case for much longer. These fundamentals are certainly complex and not simple to perform. In terms of both the technical knowledge required and, more importantly, the time needed for the analysis. If you'd like to get started with learning this, have a look at the description of this video for a good financial analysis course. Another option that is available, however, is investing in value ETFs, which have a mandate of investing in stocks that are potentially undervalued. These are issued by most of the large fund managers, such as Vanguard, Invesco, etc. These come with management fees, but they are typically quite low, as with most ETFs. This is also a good way to dip your toes into the value investing waters. Number 2. Ignore hype. It's very common to see certain investments being hyped up online and in the media nowadays, with claims of crazy, supersized gains of tens or even hundreds of % growth being touted in a short period of time. In most cases, this is just that, hype. However, it's easy to get sucked in and get dazzled by it. There's also the Fomo Factor, especially when we read about how some of the prominent stocks or cryptocurrencies have grown so much in such a short span of time. We naturally want to get in on the next Tesla or Bitcoin and jump on that rocket ship to outsized gains. However, the usual case is that once an investment is being hyped up all over, it's probably too late to get on board, as the price has probably already jumped. Chances are, it's no longer undervalued and might even be overvalued. Does this mean that you can't make money with these investments? No, of course it's still possible if it's a solid investment with growth potential. However, your scope for gains will be a lot less since you're getting in at the 10th or 20th floor instead of at the first floor. Number 3. Have a long-term mindset. This could be the most important principle of all. We all want super high gains in a short period of time, but as realists, we also know that this is next to impossible, except if you strike the lottery. And we can all agree that that isn't exactly a viable investment strategy. Getting into the investment game with a get-rich-quick mentality is a sure path to misery and disappointment, as that is simply not how money works. Let's get back to the core of what value investing is, which is buying into assets that are currently undervalued by the market. Now, there's no fixed time frame in terms of when the market will realize this undervaluation and raise the value accordingly. But as long as capitalism exists, this is very likely to happen, though it may take a while. If we get jittery and ditch our value investments after a temporary 5% drop, we may be missing out when the asset recovers and realizes its true value. Having that long-term mindset allows you to ignore the short-term noise and volatility. The other benefit of a long-term view is that it allows you to be more picky at investing. After all, if you're looking to become a millionaire overnight, you will naturally feel more pressure to invest at the first opportunity, rather than being patient and taking only the best investments. In conclusion, value investing is all about looking for diamonds in the rough, acquiring them, and then simply waiting for the rest of the market to realize their value. There can be a fair bit of technical and financial analysis involved that is required to properly execute value investing, but the potential rewards can certainly be worth it. And as it is with most types of investing styles, having a long-term view will give you the best chance of coming out on top. I hope you got some useful insights from this video. Give us a like and subscribe if you did, and see you next time on Money by Sunny.